What's up, Outliers? Happy Saturday. Today we are taking a look at this report because I have not had a chance to review it with the community yet. And there's a lot of really good information, especially for anybody that touches derivatives, which is a lot of folks. So we'll review this first, and then the rest of the stream, we can do whatever you guys want. So if there's specific stocks you want to look at, if there's questions you have about trading, anything like that, let me know. I have a couple emails that I've gotten that if folks don't necessarily have something that they want to talk about, then we can take a peek there. But so far I see Level, I see Kirk, Reese, ZX. Great to see everybody. ZX Borg is a great name. For those that don't know, I played rugby in college and I had a buddy. His last name was Borg. So whenever I would play rugby with him, he was the epitome of sacrifice the body, which is awesome. That I loved playing rugby with that dude. So every time I see ZX Borg, I think of my buddy Borg from rugby, and it's a good memory. So thank you for having a cool name. Level says, Eric, I've noticed that when I look up VRP in unusual whales, I feel like I'm getting old news. It seems like it's 30 days old. I want to know what VRP is now. Measure it. There is no other way to know exactly what it is now. That's where the edge is, right? If there was some sort of indicator that told you definitively what it is at this moment, then there goes the edge. That's the entire point of it. So unusual whales isn't giving you 30-day-old information. It's giving you data that goes back a certain duration, but then the rest of the data that you have is much more recent than that. So for example, if I look at risk premiums and I go to the last plot here, it gives you what it was, from like the 23rd of December, so trailing about a month ago. But then if you take what this thing is telling you, which is tracking implied versus realized vol, and you look at something like this, well, it tells you exactly what it is more recently. So in this case, you can see realized vol is down there, implied vol is up here, and yeah. So you're not going to find an indicator that's going to tell you definitively, right now, risk premium is blank, because that's exactly where the edge is. Otherwise, it wouldn't be there. Realistically, when somebody is trying to trade risk premiums, they're really making a generalized bet in terms of what we think it's going to be going forward. So do we think that risk premiums are rich compared to what we think it should be? And the way that you determine, what it is right now is actually through your own measurement. It's quite literally the only way to do it. But if you don't have a sophisticated method to sample and forecast volatility, which is admittedly very difficult to do, then you have to think of a different way to approach it. One of those common ways to approach it is to try and think of the general conditions where it exists, and then acknowledge the fact that you're never going to be able to perfectly time it, but as long as you can be pretty good most of the time, and you can measure that it's typically there, then in general, you'll be a lot better off. So for example, if we look at this period here, we can see that realized vol starts massively exceeding implied vol. And notice how it's not like a whipsaw. It doesn't exceed, implied doesn't exceed realized and then drop right back down and drop right back up and drop back down and drop back up. You can see that it actually exists for a little while. And then the same thing here. You can see that that realized vol starts trickling up towards implied, and then it's hovering around implied, sometimes exceeding. So this is literally the job of a trader. You have to measure it, and then you have to come up with your own expectation of, what do I think implied vols are now relative to realized vols? Do I think that they're rich? Do I think that they're cheap? And yeah, that's your job. So I definitely don't blame you for wanting to know what VRP is now, but you are the one with the answer. Congratulations. That's a beautiful part. You have the answer. BRB says, interested to hear how you'll trail momentum trades with a sliding stop. Been experimenting with trailing previous day low in back test, but looking to refine this. Yeah, I have a really, really specific approach that I use that honestly I wouldn't share broadly because it doesn't do me any good to do that. But what I will say is the methodology behind it is really simple. And it depends on the kind of things that you trade momentum in. That's one of the most important things to pay attention to, because even if I told you exactly how I like to trail momentum, which I could, but momentum looks different in different things. So let's say, for example, you're trading momentum in mega cap names and I'm trading it in growth names. The way that I choose to trail and to try and maximize profit as much as I can, that will look different than doing it in mega caps. So I actually have a different playbook depending on the profile of the underlyings that I'm trading. The easiest way to think about solving the problem set, though, in developing your own rules is really easy, and you're on the right path, which is awesome, through back testing and taking a look at stuff. Let's say that we pick an underlying, I'm going to pick United Airlines, literally just because I don't know what it's done recently. I haven't paid attention to it at all. And let's say that you like it back here for some sort of momentum play. What you can do is take a look at the underlying. BRB says, so volatility adjusted momentum, definitely a way you can think of it. And that's an easy way to try and normalize it. Now, volatility is only part of the equation, unfortunately. And again, it depends on how deep in momentum you want to go. Just like anything else, at the surface level, momentum is really simple. You want to buy winners, sell losers. That's literally it, right? Super simple at a high level. But as soon as we start double clicking in a little bit, it can get more and more intricate, because your instinct there is exactly correct, spot on. But there's more to it, because if I look at the implied vol in United Airlines at 40%, and then I take a look at the 30% implied vol in Apple, and we take a look at the total ranges, total 12-month range there is 71%, UAL, it's 129%. You see my point? They're 10% off in terms of their vols, but their total ranges over the last year are insanely different. So just like anything else, that's a good starting point, and it depends on how refined you're trying to get in the overall application. But what I will say is, once you understand the different kind of buckets that you're trying to trade momentum in, another great example is, let's say that you're doing a sector rotation strategy. I talk about that a lot because it's easy for me to talk about. It's very non-specific. It's very well known. So it's not like I'm diving into any sort of uncharted territory here. It's a really great base example. But if I look at the 30% implied vol for XLK, which places it about 77% total range, and I'm trying to follow momentum in sectors versus individual names, the way that I do it will look different. So what I need to do is rough out the strategy as I see it, as I think I'm going to trade momentum. And then I need to back test it. And then based on what I back test, I can then refine and try another approach. So let's say, for example, I want to trade momentum in XLK, and as long as it is above a 20-day moving average, I'm going to be long. If it drops below a 20-day moving average with a close, then I get out. And I'll find, okay, well, it works well for a decent amount of time, and then I get chopped up a little bit depending on how bad that chop is. I can either say to myself, well, is there a way for me to add another feature, or does that start to overly confound what I'm back testing? The easiest way to validate that is, let's say that you run it with a 20 period moving average, and then you say, well, if it drops 3% below and then it closes, or it's about to close around there, I'm going to get out. And let's say you try that with 3%, it looks like it improves the performance of your strategy. But then you say, well, now I need to do a little bit of a robustness check. The first thing you could do is say, all right, I'm going to take it out of XLK and I'm going to run the other sectors. How does this perform? And if it completely breaks down, you know you're overfit. The other thing you can do is, instead of 3%, you can try 2% or 4%. If that massively changes the performance, you know you're overfit. So part of it is literally this just hypothesis, test, hypothesis, test, and it's this iterative process. So you're already doing the thing that you need to do in order to get to the answer for sure, based on what you're trading. The way to think about moving your stop is it's balancing. You're looking to strike a sweet spot. I'm typically thinking of it in terms of I want to get most of the move most of the time. And one of the things that actually starts to confound the idea of the sliding stops, which is a big part of what I do, is actually scaling in and out, which is a little tricky because as soon as you add some sort of scaling factor, testing also becomes really, really annoying, at least for like the beginner level programmer. Once you get a little more familiar, which by the way, I still consider myself beginner level for sure. I'm just highly specialized. What I know for programming is very, very specific to market stuff. But to summarize all of that, you got to define the strategy as you think you're going to play it. You got to define the tradable universe and the profiles for the tradable universe and how those change. You got to come up with your best guess on how you think you might approach it. You got to back test it. As you back test it and you observe results, then you can iterate and think about what other features, what other tweaks can you make. As you go about making these other tweaks, you have to make sure that what you're doing maintains robustness. And you can do that by looking in sample, out of sample, randomized samples, different things to make sure that what you did is not completely overfit to the thing that you're looking at. The good part with something like momentum is that the base factor is real, observable, measurable, and historic. What that means is, if you're trading momentum, you're not trading bullshit. You're not trading an idea that you think might work. You're trading something that's really well studied and has decent track record behind it. So then the main way I would think about trying to capture momentum factor is not by doing too much, and what I mean by that is like adding too many bells and whistles, but more so by not fucking it up. If you try to add too many features, you start changing the base effect. So the way that I think about trailing and just following momentum is I literally employ a standard technical analysis suite, and it's got to be matched to the time frame. That's a really important factor. So let's say, for example, I'm trading 1 year momentum factor or 6 month momentum factor. That looks a lot different than if I'm trying to trade like a 10-day reverse momentum factor or some other variation of that. That's the overview. If you have more specifics on that, I'm happy to try and direct you as best as I possibly can. Based on what you've said so far, though, I think you're literally moving the exact correct direction. And it's important to remember that iterative process, that's just part of this gig. Most of the time, you'll spend your time looking at stuff that you think might be a good idea. You think that there might be value there. And then you look at it for a little bit and you realize that this isn't a good idea. More often than not, that's what you're going to find as a trader, that your idea is not good. That's normal. And it's, again, think of it logically. How many ideas have been tested and how much money is residual left to be made? Most ideas are going to be priced pretty well at this point. That's not all. And if you think of why the profit mechanism exists, that gives us a ton of context as to why that profit mechanism might continue to exist, even though something like momentum is really well known. And the base concept there is volatility. If you're trading higher momentum stuff, more often than not, you're trading something that's going to have a little bit higher volatility in your P&L. So there's balance, as all things should be. Great questions. Let's learn about the state of the options industry from CBOE. I'm going to go to like 130%. There we go. Maybe 140%. 130%. There we go. Okay. 2025, the sixth consecutive record year for listed options. Total volume reaching 15.2 billion, which is up 26% year over year, with rising retail and institutional flow. This part's really important to keep in mind, by the way, because this is an interesting trend. the fact that institutional flow is scaling alongside retail, and you'll see a little bit more about that in a little bit. Daily option volume is up to 61 million contracts, which is crazy. But this has a lot to do with all of the zeros offering. They're now looking to start offering zeros and individual tickers. The demand is there for sure. 41 days top 70 million, including the first ever 100 million day on 4 April. Index options are about 5 million per day. Retail, here we go. Retail self-directed brokerage accounted for 50% of volume, with particular focus on single stock and 0DT SPX options. Block trades greater than 1,000 contracts accounted for 10 million a day, which those are in something like SPX. Those are actually, that's a pretty big trade depending on what else is in it, but that's pretty cool. Miami trading floor opened. IEX 2026 launch, raised venue count to 19, 7 operators. Okay. Oh yeah, and then there's also the easing PDT rules. I like that just because I typically am a little bit anti-regulation. I just want people to be able to make their own decisions. But at no point do I think that this is going to lead to retail traders making more money. I actually think this is going to hurt way more than it helps. But they should be allowed to lose their money however they feel like it. It is their money to do whatever the fuck they want, and I support it. Let's see. So calls and whoa. I didn't expect the gap between calls and puts to open up this much. Typically speaking, when I look back historically, calls and puts, they were within like a much smaller range. This starts to open up huge. 2021 was a bit of an anomaly. 0DTE volume, that doesn't surprise me. And the way to think about the 0DTE volume is like, not all of it's bad. It doesn't mean that people are just like gambling and YOLOing their money. Realistically, people that are trading 0DTEs and SPX, they got to have at least a little bit of money. But the downside to that is a lot of people will unfortunately get completely wrapped into these really short-term timeframes and miss actually a lot of really good opportunities on longer-term timeframes. Short-term timeframes are unforgiving. And the other thing to remember, I trade a lot of 0DTEs, as you guys know. But the other thing is that it's very transaction heavy. That's one of the biggest downsides, especially when I see people that are trading 0DTE strategies that have all these adjustments that they do throughout the day. That's a lot of transactions on a really short-term time frame, and those transaction costs add up quick as hell. So definitely something to keep in mind if you choose to venture into anything like that. Notional, damn, 4 trillion. 4 trillion, huge. And let's see anything else that sticks out. Max contracts 2 mil, max expiries 82, which is down a little bit. Let's see. Yeah, so we know that the general volume is skyrocketing. We also know this. Here we go. Let's see here. So the top volume leaders, there's SPY at 41%, Qs at 20, small cap IWM at 18. That all flows generally logically. I'm surprised IBIT is that small at like 3. HYG, or I guess that's SLV or HYG. I can't really tell with these colors. Whoever made this, they should be fucking shot, because I can't fucking tell the difference between this blue and this blue. And what the fuck are we doing here? Make them, there's so many other colors that we could pick that are not direct 1 pixel off or 1 hex code off of colors. I think this is designed to be like a fuck you. That's my best guess. Because why the hell else would they do this? Bastards. Indices, SPX is huge. Yeah, vol also huge. This is interesting even to see XSP and NDX, or I'm sorry, XSP even on this. I'm surprised RUT is that small. But XSP, by the way, for those that don't know, that's not an unrealistic place for smaller accounts to even start to explore 0DTEs, which I have a video out. I have an entire playlist on 0DTEs. And it's not a bad place to at least take a look, to get your feet wet and, you know, scale things down. But I will always go back to, if you're trading 0 DTEs with a small account, you're in the wrong you're just in the wrong place. It's not a good place to be. But the reason why I make that content is I don't know if I would have traded 0 DTEs. I definitely know that I traded options quicker than otherwise I would tell myself to. And I know that I wouldn't listen to it. So I don't know if I would do that with 0 DTEs, but there's a good chance. Let's see. Don't really care about these. Jesus. Yeah. I mean, I just think the growth of options, especially from first, it's not just like what happened during COVID. That's a big part for kicking it off. But my expectation realistically is that a lot of the people that started trading options during COVID, they're fucking gone, right? We're past that 5-year mark. Realistically, and I've said this before, like the proving grounds is 5 years. If you make it beyond 5 years, there's a pretty good chance you'll be able to figure something out, survive. Whether or not you have some sort of massive market outperformance or not, that's a whole other bag. But we do know that the threshold for people not trading and quitting is typically within the 5-year mark. Most of those people from 2020 that started trading because of stimulus and because of being at home and all that kind of stuff, like most of them are fucking gone, I bet. I don't know for sure. It's conjecture, but I would make that bet. This tells me that there's still a lot of fresh entry, and a lot of that has to do with options becoming like more mainstream. They're still far from anything like actually mainstream, but definitely more mainstream. I have people that I come across at the gym that's actually funny. That's the first place I've ever been recognized in public, was at the gym. And it was some random dude that I've seen before, but I've never spoken to. And he said that he stumbled across my channel and that, you know, he was trading options before, but I could tell clear as day the dude had no fucking idea what he's talking about with respect to options. And he was trading them though. And that's how it goes. So I just think it's going to continue to become more and more mainstream. And I think options just have such a fantastic use case, as you guys know. I really think that they're awesome instruments. Really, really valuable. Don't care about this. Don't care about this. Overnight volume. Yeah, that's pretty static. Let's take a look at this. Average execution size. This makes sense. I'm wondering what the median is. I would really, really like if they had a median here. The part that's kind of interesting is that this downward slope was even before 2020. The number being low post 2020 makes sense because a lot of retail traders have entered the equation, about 50%, which will drag that down. That part I get. But this broader decline is interesting because it clearly started from a while ago and it was already down 3/4 almost before this. So that's been on a downtrend for quite a while. Total OI. So individual underlyings primarily. Indices are pretty small. That's actually really interesting. I wouldn't have expected. I didn't look at this part. I don't remember these. I'll look through these. Ah, perfect. We were literally just talking about risk premiums. And let's see. I mean, risk premiums are there, happy and healthy. This is a really, really good plot to show you that risk premiums still have a seat at the table. And you can see where these spikes are, which is actually really interesting to see how insane some of these spikes got. This one is really cool to see. Let me see, figure out how to fucking zoom in enough. This was a really cool one. I remember looking at this one. So for those that don't know, first let me zoom out to show you what you're looking at. What you're looking at, and there's a tool, by the way. I'll show you the tool. This is the tool. And it's paid, and they also have a free version, I think. But this platform is actually really, really cool. But what you're looking at here is for an individual expiration cycle. You're looking at a volatility smile. So November 21st is the expiration cycle that they're looking at. And then it's breaking down what things look like for out of the money options. And this vertical line here is where at the money is. You use the out of the money to plot these vols. So when you're down here, you're using out of the money puts. And then when you're here, you're using out of the money calls. This is what we know as put skew. Typically speaking, puts tend to be a little bit more expensive than calls. But they highlight some really cool pieces in here. So this is showing the price for tail hedges. And these are the folks that are buying. This is like the Nassim Taleb kind of crowd where they're accessing super, super far out of the money options that are super, super cheap. But on a relative basis, they're really expensive. And I'll show you. Let's go like 54 days out. And let's take a look at the vol as you go further and further out. Let's go out like 250 strikes. Notice what happens to the vol on the puts. The vol on the puts for the at the money is like 15%. The vol on the puts that are 250 strikes out are at 22%, seven clicks higher. That is people drastically overpaying. Now, the funny thing though, is that because these super far out of the money options haven't been around that long in size, we actually don't know what fair value is. And that's something that you and I have talked about on the Outlier podcast a little bit. Kind of a fun fact that we literally don't know if they're fairly priced or not. But the assumption is not so much. Then there are people who are selling really far out of the money options that are just trying to collect a premium. And the trick for these folks is a lot of times, I mean, they're getting vol here. This is like 40%-ish. Yeah, about 40%. So pretty far out of the money. The at the money is like 66.50, but they're at the 5,300. So this is selling the tails, and it works a lot till it doesn't. Then there's the buyers, value buyers, people selling out of the money calls. This is typically against long deltas that they have. And then these are people that are looking for convexity. I actually really, really like how they break this down. Now, as always, I don't actually think that it's quite that discrete, but nonetheless, I like it as a general overview. This gives you a plot of put call skew relative to 30-day vol. You can get a sense of how effective those are at capturing like volatility and changes in volatility. This one I don't really care about. What is this? Oh, this is just showing sliding along a curve and how sliding along the curve impacts. So this is in Netflix, yeah. Don't care. CBOE is still dominant. NASDAQ second. ICE third. Miami fourth. Here you go. Take a look at this. Market makers. 67 million daily volume. Yeah. Yep. Oh, this I don't care about. This is just the number of listings. So the interesting thing with this actually is the ETFs. Take a look at ETFs. That one is really interesting to me. ETFs have fucking exploded. They have gone from under 1,000, literally like 10 years ago, and they've tripled. The number of ETFs offered are absolutely wild. There's an ETF for just about everything. A lot of these are like those different income ETFs that you probably have seen, stuff like that, which is again, just a really, really interesting growth in industry trend that has been going on for a while. One of my friends, Wes Gray, who's been on the podcast, he's the CEO of Alpha Architect, and they make ETFs and they white label ETFs. This is their business. There's a massive demand for ETFs. And the other thing to note is that it's gotten easier and easier to make ETFs. So the hurdle to build one for yourself is lower than what it was before, which also obviously increases the frequency that you're going to come across them. Yeah, they're just about everywhere. This gives us just another view of volume, premiums. Oh, this is cool. So this gives you an idea of average daily volume by size in terms of lots. And take a look at this line here, this like dark blue line. This is the 1 to 10. So there's different studies out there that try to flag retail orders, and this is one of the criteria. And it's not perfect, but it does give you a pretty good idea in terms of where retail is, because I've never traded, a 5,000 lot of SPX at once. That's a massive position. So those kinds of things are going to be really relegated to larger institutions and stuff. But the growth of this bucket specifically, that's a lot of retail, I think. The part that I don't fully understand is this. No, I guess I do understand. Never mind. You can kind of see that drop happens every year around December. Seasonality to a degree, but that looks kind of blown out compared to these. Let's see. Oh, complex orders. You want to avoid those. Retail brokers, look at Robinhood. And then Schwab. Schwab is where, because they also consumed TD. Tasty Trade is way down further than I thought. They're at 640K. Trade Stations 255. Trade Up, which I literally have never even heard of, is at 318. What the fuck is Trade Up? Have you guys heard of that before? I do not know that one. Futu, fun fact, Futu reached out to me to see if I wanted to do like some sort of collaboration with them. Same thing with Webull, but both of them I turned down. Kind of a bummer to see Robinhood this high. Fucking hate Robinhood. Skew inversion. I mean, the overwhelming. So effective versus quoted spread. Yeah, so this is also really, really cool to see, because the spreads themselves look like they're getting a little wider, but this also will align with a lot of offering of like zero DTEs and stuff like that. This naturally will do that, but the gap between these is really wide. So that's actually good. That means that where you're actually trading as relative to the quote is a lot better. But this is kind of fake, right? Because this is also payment for order flow bullshit with price improvement. So like, it's cool to see the effective gap here, but there's also a lot of fuckery that goes into making that as it is. National best bid and offer, that's gotten tighter. Zero DTEs. You already know that they're fucking crazy. Oh, here we go. What is this? New type of contract. Yeah, I mean, there was zero DTEs before. There just wasn't as many of them. Pose large systemic risk. Of course, they'll say this. There's a lot of paper out there talking about what kind of potential volatility zero DTEs can lead to the market. And CBOE's actually put out different papers about it. And dude, look at this. 32% lives here. 24% lives here. Jesus. crazy. Zero DTs make a lot of sense for a lot of people. It's a really, really good way to cover risk on really short-term time frames without paying for stuff longer than you want to. Let's see here. Okay, so this is opening. And I was hoping that it would break it down. This is the standard flow of liquidity that you guys see throughout every single day. You literally can see this because opening is a bunch of overnight orders that have to clear out. And then the last couple hours is when a lot of institutions that are taking, positions and positionally trading are coming out. This is a lot of stuff that's like resting orders, hedge funds, pension funds, shit like that. And I know that this is zero DTE specifically, but same ebb and flow that you'll see across volume during the day, unless news comes out. If there's some sort of big piece of news or something, you'll see it here. Tom says, how do you think 24/7 trading will be more opportunities for retail? It definitely can offer more opportunities just in terms of access to markets in non as sophisticated ways. So for me, I'm not looking forward to it because of futures, and the fact that futures are less traded definitely allowed me to take more advantage of those overnight moves. But I do think it helps retail traders in a few ways, especially like if you're hedging an earnings move. It'll smooth out volatility. It'll probably negatively impact the variance risk premiums that you see through earnings plays. This is actually a great example, by the way, of why it is so important to constantly do your absolute best to evolve, because you never know how the market's going to evolve. And the fact that, we go from Monday, first it was just standard option expiration, third Friday of each month. And then, went to weeklies, and then throughout the week, Monday, Wednesday, Friday, at zeros, like all this stuff changes things. And if you get stuck in the mud as a trader and you don't really bother trying to evolve what you're doing, there's a good chance some of the stuff that you do is not going to work as well over the long run. Like there's a really, really good chance that the earnings effect will be impacted by this, because a big part of the earnings effect is that they're reported after the close, and that limits what kind of things a trader can do. People use options to hedge through that. But if you don't have to use options to hedge through that because you can trade the underlying itself, that has a big impact. There's a really good chance earnings plays are going to look a lot different. I don't know if it'll go away. I'll have to see what it looks like, but it's definitely going to look a lot different. I don't care about this. This is ridiculous. Don't trade here, by the way, guys. Trading in the last 5 minutes is fucking crazy. Liquidity starts to get really shitty in there. And then flex options, which I don't really care about. Shout out to Zoltar, though. Glad that they included that. Reese says, how can you better discern a breakout versus a fake breakout? You prioritize it. So the way to do that is you look at a bunch of breakouts, you understand and you measure them. You understand what the preceding movement looks like, what the post movement looks like, and then you just take a probabilistic guess from there. The way to think about this is like, think of being a defensive player in some sort of sport, or a quarterback. I was listening to a thing about Tom Brady. And they were talking about how I think they were playing the Seahawks or some shit. I don't know anything about like football. I don't watch any sports, but they were playing the Seahawks or something. And the Seahawks, it was Marshawn Lynch. And he was saying that they had to like completely disguise all of their defensive plays, because if they showed anything, then Tom Brady would immediately have a pretty good idea of what it is and then adjust accordingly. So what that led to is a lot of times they were literally waiting until the ball snapped before they started to move, which a lot of times, you try not to wait that long, otherwise you're a little bit behind. But that was still better for them because of Tom Brady's capacity to read what they were doing. And it's like the same thing. How did Tom get so good at knowing if what the play was and what the defense was, if it was actually what it was going to be, if it was a fake of some sort. And the way he got so good at it was studying by looking at tons and tons of tape about the teams themselves and developing that pattern recognition. Same exact thing in stocks. You literally just have to look at thousands of them. And once you do that and you have a pretty good idea of like what they look like, it really becomes easier to identify the criteria that you like. And that's also one of the things that I will say is interesting about the human brain and the ability to detect patterns, because some of the stuff, you know, when I'm trying to create scans to help me identify things, I realize like how many things I'm actually looking at when I'm analyzing something before I'm pulling the trigger. And it's just a lot of it is subconsciously going on in the brain. So, yeah. Black Mama says, have you heard we're going to have expiries Monday, Wednesday, Friday? On what ticker? On what tickers? So, I mean, we already have expiries Monday, Wednesday, Friday for like the indices themselves. So my guess is that would be for the like more mega cap style tickers, which are effectively the same thing that we have now. There's tons of volume there as things sit. So I think it makes sense. I don't think it hurts anything. I think the main thing is just being mindful of cost. I think that cost tricks so many retail traders because access is so easy to get at. But I wouldn't confuse the access with like cost or how frequently you should interact. You definitely still want to try and decrease how much you're interacting with the market, because whether you win or lose, the cost is there and the cost will add up over time, especially if you're a smaller trader. If you're a smaller trader, what you start giving up in terms of like, you know, friction per contract, especially like, let's just look at an example. I think you guys said last time we spoke, like an average cost is like 65 cents per option, which again, by the way, you guys should always negotiate. You should not pay anything more than you need to. But let's say that you're trading options, you have 65 cents per contract. And let's say that you want to trade SPX, or let's just do XSP. And you want to place some sort of short-term vertical spread. So let's say that you do short the 688s and let's say you do $2 wide. And you're going to get like 33 cents. So you're going to make 33 cents. You're going to risk $1.67. And you're going to have two contracts. So your total here I did that the wrong way. Your total friction is not insignificant. That's just to enter. This doesn't include any sort of exiting positions. And this is exactly why, if you have a smaller account, this is exactly why you get eaten alive here, which is exactly why I'm glad PDT is going away, because I think people should be free to make their own choices. But I would still guide people away from that really short-term active style trading with a small account, because you are getting consumed alive on this. It's awful. And that spread isn't like unfair or anything, but it's just relative to what the trader is trading. It's very expensive. So yeah, bad news bears. Kirk says it's the Mag 7. Yeah, it makes sense. That are getting dailies. Yeah. Wait. All right, gang. Awesome hanging out with everybody. You guys know where to find me in the Discord. Outlier Pro members, we have market prep tomorrow. Be an outlier. See you guys later.